Holy hell. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, a major threat to Trump's economy just surfaced, and as you're about to see, the fallout could be huge as millions of American households are now at risk. Plus, we have a sponsor for today's show. I'd like to welcome SOL Global Investments to the show. You can find them on the CSE under symbol SOL and on the OTC under symbol SOLCF. And they're focused on the price appreciation and generating yield off the token Solana, and this is very similar to what MicroStrategy is doing with Bitcoin, and Wall Street absolutely loves this as their stock is now entering the second phase of a major swing. This is one you don't want to miss out on. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where he picked today's story up as U.S. companies have added a mere 146,000 jobs in November. This according to ADP, and this is a huge problem for Trump's economy because what we're seeing is decelerating payroll growth heading into his term that doesn't start until January. So he has no opportunity here to change the labor market, and by the time he takes office, things could be much worse. And from the global economy's perspective, well, when things start to go wrong for the U.S. economy, well, it means absolute devastation for the rest of the world. And private payrolls rose by 146,000 last month after an October increase that was revised down to 184,000. And this is something we're seeing with the headline payroll data, continuous downward revisions. It's all about the data. We know the data is highly inaccurate here, particularly at the government level, who moved all the local level jobs to Washington. And that means the quality of our payroll reports going forward are absolutely horrible. I mean, we're likely to see further downward revisions. The report showed employment growth was mixed among industries. Education and healthcare, along with construction, led gains, while manufacturing employment, this is a critical one, dropped by the most in over a year. Hiring, leisure, and finance was also soft. And this is very scary for the U.S. economy because the manufacturing sector in any economy is absolutely critical. And when you start to see the manufacturing sector decline and start to cause layoffs, well, it's only a matter of time before it impacts the services sector because manufacturers, well, they drive about 70% of services side consumption. There's a huge risk here to the U.S. economy. The ADP report showed wage growth picked up. However, workers who changed jobs saw a 7.2 increase in pay, and those who stayed put experienced the first acceleration in 2 years. And what I want you to see here is how the mainstream media is covering up the truth, because literally right in the press release of ADP, it showed the income for job sayers increased by 4.8%. Now, why the media wanted to cover this up, I'm not really sure, but there's a real issue here is a lot of people are going to look at this data and say, well, that's great news. That could drive inflation as people are getting wages. And that's what we're likely to hear from the Federal Reserve later this month. But it's a danger sign for the U.S. economy. It's a huge warning. I'm going to show you how this is going to affect millions of households, because let's take a look at this chart. When we look at average hourly earnings of production and non-supervisory employees, this shown in blue on a year-over-year rate of change. And when we see it decelerate amid rising continued unemployment claims, well, it's a dangerous sign, because what it means is workers are losing their jobs. And we talk about how this is going to affect millions of American households, is we could see Americans losing their jobs at a time when we're keyed on a global turnaround centered around U.S. consumption. But if we do not see wages continue to increase at a fast clip to offset inflation, well, what it means is consumption is going to decline, and that means Americans are going to hit the unemployment line in a big way. We could see that happen again right around the dot-com bubble as wage growth peaks and then decelerates as Americans lose their jobs. We have it happen again during the global financial crisis. So it's important to understand here is while the data says, hey, there's payroll growth, well, that happens always during a recession. People who do have their jobs continue to get wage increases. They're just not as much as they're used to or hoping for. The problem is that means Americans are hitting the unemployment line, and we're seeing now what ADP is telling us is that wage growth is continuing to decelerate amid rising continued claims. But let's talk about a chart that's looking to head a lot higher, and that is for our stock, for our sponsor. They show SOL Global Investments. You can find them on the CSE under symbol SOL and on the OTC under symbol SOL ULCF. And we can look at what a swing trade is. So this is when you get a close above a rising 9-day moving average. That happened right back here. The stock took off. It's pulled back underneath its 9-day. Now, for some people, that triggers a sell. Really, the sell signals under the 21-day exponential moving average. Here you can see today it's looking to make a close over the 9-day and set up another leg higher. This is a stock that Wall Street loves and one we think you will as well. Stay tuned to the end of the show for more information. But let's continue on what's going on with the U.S. labor market, because U.S. services activity now expands at the slowest pace in 3 months. And this is a huge change, because what we've been hearing is the services sector in the United States was going to drive the manufacturing sector. And we've looked at the data and we've continued to say that where manufacturing goes, services follow, because manufacturers drive a massive amount of services consumption. Well, what we're now starting to see is a slowdown hit the services sector, threatening in a matter of a couple months that could be heading to a negative. The Institute for Supply Management Index of Services dropped 3.9 points, the first decline since June, to 52.1 last month. While readings above 50 indicate an expansion, the key here says the expansion is slowing. The group's new orders gauge decreased by 3.7 points to a 3-month low of 53.7. So what we're seeing here is new order growth start to slow down, and this is dangerous, because remember, the workforce in anywhere there's manufacturing or services, they need new orders and they need backlogs. You get both, that means people have jobs. You start to see slowdowns, and well, that means they're going to have layoffs. A measure of business activity which parallels the ISM factory output gauge also fell to the lowest level since August. And survey response noted some apprehension about the potential for tariffs after President-elect Donald Trump's victory. So what did we hear before the election? That was all about election uncertainty and the consumers weren't spending. Now we're seeing a change in that from the services side, saying, well, maybe things are going to get better, but not until this tariff issue is dealt with, suggesting that all along the election wasn't the issue. The issue was that U.S. consumers are running out of money. They can't keep up with inflation. And here we can see on this chart that the services sector that everyone was banking on the turnaround of the U.S. economy and the world economy is now rolling over to the downside following the manufacturing sector. And combined with data earlier this week is now showing an 8th straight month of contraction in manufacturing. The services survey suggests moderating economic growth in the final stretch of 2024. That is before we start to see the services sector decline and follow the manufacturing sector lower. And the evidence of that is strong as we look at the easing of business activity along with a 4th month of declining backlog of orders and a slide in export demand. So those are critical, because when you look at what we need to see people have jobs, get more hours, demand pay increases that they can keep up with cost of living, well, they need work. They need the new orders to continue to rise. They need the fax machine to run, but they also need that backlog to stay there. What we're seeing, the backlogs get worked down. We're seeing export orders fall, and this means we're going to see hours cut and then employment get cut. And this led to a tempering of employment growth at service providers. The ISM measure slipped 1.5 points to 51.5 last month, suggesting that employment among service providers grew very slightly. But let's look at some of the comments that we saw from the survey, as Federal Reserve rate cuts have not had the desired effect on mortgage rates yet. Well, that's simple, because the Fed chases the short end of the curve. We looked at these charts where the Fed responds to approximately 6-month Treasury yields. But why have long-term rates not come down? It's simple. Everyone believes that a slight cut in rates is going to lead to an economic boom, driving growth and inflation. What we're seeing here is the market bet on that, and yet what we're hearing from the services sector is that's not going to happen.